this is a chart you likely have never seen before. This is the long-term Bitcoin chart starting in 2010 divided by the Nasdaq 100. So the US technology stocks historically. That's the line here in green, and what we can see in white is the monthly RSI. So the relative strength index, a technical indicator derived from these relative prices, the relative performance of Bitcoin to US stocks. And it's interesting that once we are above 95 on this monthly RSI, we tend to be pretty heated, right? We can also look at this price in terms of ranges, right? The monthly high and monthly low. So in case you're not aware how this actually works, let me quickly show you this. So an open high low close candle, as you can see over here, it describes at what price did the month start, what was the lowest price of that month, what was the highest price of that month, and then at what price did the month close. Okay, so we have both the range at which Bitcoin relative to the Nasdaq was trading within the month. We know when it started, at what relative price, and at what relative price did it close. And we switch this to the candles are simply just a different representations of the same thing, right? So the opening over here, the closing over here, and this is the trading range. When the candle is green, it means the closing was higher than the opening and vice versa. I personally prefer to rather look at it in the open, high, low, close candles. I think it's a bit more pleasing to the eye. And so we can see historically, when we have been really high on this metric, we also saw quite high values in this relative valuation, right? We afterwards dropped temporarily by 80% over here. And in November 2013, we also had then our subsequent Mt. Gox crash, also by almost 90%. Now, what's interesting, why most people didn't see Bitcoin peaking in the 60K range is because we didn't see that high of an RSI level, right? This is just one of many technical indicators that actually did not yet blink completely red. And I think this has to do with the fact that a lot of people tried to front run this, right? So the risk to reward was already not so great once we were that elevated, and people simply didn't want to wait until we hit those higher values. It was simply too risky. Now, when we look at the lower values, we can see we are now again very, very low. We have in fact never been that low. So we are now below 44 on the monthly RSI. Now, does this have to mean that we have to turn around now in the grand scheme of things on a monthly basis and that this is the bottom? Not necessarily, right? The same way as we don't have to hit 95 for the top doesn't mean that 44 has to be the absolute bottom, but it does tell us that in relative terms, we are now comparatively cheap. We can also look at this on a weekly time frame. So I've changed now the tick size to 1 week. And with that metric, we can actually see quite a peak in January of 2021. We afterwards still went up quite a bit. So the price didn't stop climbing. We went up another 50% roughly. But we did see that overall, we had peaked in momentum, right? Afterwards, we were pretty much in somewhat of a sidewards trading range, maybe even a slight downwards trend, depending on how you measure this. So once we hit peak RSI, the positive momentum was pretty much gone. Now, when we look at the lower band on the weekly, right, it's of course also lower. Again, a very similar picture. Let's look at the lower values before. So let's look at December of 2018. This was pretty perfectly the bottom here, right? So note how these things align. We are relatively low here. We then saw at least a very small temporary rally. Then we were even lower in January 2015. This was pretty much the peak. In fact, it was exactly the peak, right? It was as low as it ever got. And then we turned around. So this is not necessarily a measure to show us exact peaks. It's rather a measure to show us where the current momentum temporarily might run out of steam, right? So here in June of 2016, also relatively elevated. We first saw somewhat of a sideways movement before it could continue to go up. So no model is perfect, but the combination of different models might be useful. Now, why do I not use directly the Bitcoin chart for this? Why do I look at relative valuation? It's because fundamentally, I think we should be diversified across asset classes. The correlation between US stocks and cryptocurrencies is increasing, but still, right, just by looking at this chart, you can see across those two asset classes, we still have a lot of value divergence, meaning you sometimes want to potentially be relatively heavy on tech stocks when this RSI, for example, is pretty high, and you want to be heavy on Bitcoin when this RSI is relatively low. You can use this kind of model. You can also use other models. There are plenty of approaches trying to find out the different trading ranges. This is simply one of them, and I think it's relatively useful if you're not that active of a trader, if you're simply just allocating. So now it would be time to move from, say, QQQ ETF to Bitcoin. And when this turns around, which it doesn't have to necessarily directly right now, right? But once we see higher values, we do see this is somewhat oscillating, then we might move that Bitcoin back to tech stocks again. And it's important to do this somewhat regularly, right? So you don't just want to trade the extremes, because sometimes you might not hit the extreme. You do want to maybe every month or every second month look at this or whatever other model you are using, and you want to be rebalancing according to your target allocations. So I simply found this interesting to show this. The long-term RSIs definitely tell us it's time to be heavy in Bitcoin now. And even though this feels painful, right? The overall top to bottom here from the NASDAQ relative to Bitcoin was minus 67%. Even though this does feel painful, that's the kind of volatility that's expected within crypto. We have seen these kinds of drops all the time. And it's usually after those drops when it's the most painful to buy where we actually get the best buying opportunities. Sometimes it can continue to fall, right? As we have seen over here, a 75% drop. And if you dollar cost averaged in during this period of time, you still afterwards saw another almost 50% drop. So this can happen, but that's why we avoid leverage. And that's why we need to have a long-term view. Feel free to give this a like in case you enjoyed the video. It will help the channel grow. And of course, if you haven't yet subscribed, feel free to do so as well. We've also got a premium membership where you can ask me any questions. There's a lot of exclusive content. So feel free to check out that video. Hope to see you there. And thanks for watching this one. Bye-bye.